I think the previous webinars were very much focused around the topics of investments, and some of the questions that were raised during these webinars provided us with an indication that our clients wanted to have a broader discussion around their personal money matters. Now, COVID-19 and the spread of the pandemic has caused major disruptions in the global economy and markets, and it has left, I think, all of us as individuals feeling a little bit more vulnerable in some way or another. And unfortunately, much uncertainty remains as we wonder when life will actually return to normal, and also what that new normal will actually look like. And we really believe that this is a time where one really has no choice but to focus on the things that you can control, and rather than becoming paralyzed by the things that you cannot control. And it is for this reason that we wanted to present a webinar that will assist you in taking more control of your personal financial affairs, and where you can feel a greater sense of comfort in this area of your life. So when we talk about the concept of holistic financial planning, then we're really talking about three broad elements. The first being what most people would actually know the most about, I believe, and that is the wealth creation element, where we talk about your investments, how do you grow your wealth. Then we also have wealth protection, which is really talking to the insurance part, be it life insurance, short-term insurance, or maybe also then your medical aid. And the last element is then the wealth preservation element, where we're really talking about things such as your wills, your trusts, and then your estate planning. Now, each of these elements are critical to actually constructing a sound financial plan and also achieving financial well-being. And I'm saying well-being as we view wealth as more than just money. You know, for us, wealth, when Sasfin Wealth and our advisors speak to clients, we also think about our clients' aspirations, their emotional comfort, their physical well-being, and then also the security of our clients. So really, ladies and gentlemen, today's webinar will take the form of a panel discussion where we have three specialists from Sasfin Wealth who will be providing you with guidance on the key elements when it comes to personal financial planning. From our side, we would once again like to just assure you that Sasfin remains fully functional during this lockdown period, and that we are able to continue serving the best interests of our clients. We also want to ask you to please visit the Content Hub on sasfin.com, where you can access more information on investment and other related topics. But back to today's discussion, the information that we'll be sharing through this webinar should not be viewed as advice, but rather as guiding principles that need to be considered as part of a well-constructed financial plan. And we'd really like to urge you to speak to one of our well-qualified and experienced financial advisors before acting on any of the information that we share during this discussion. And the reason being that every individual has a unique set of circumstances and needs that needs to be considered when constructing an appropriate financial plan. We'd also like to urge you to make use of the chat function on this webinar to raise any questions you may have during the webinar. Given the time limit and the topics we need to cover, we might not be able to get to all of your questions, but we will definitely be looking to respond to your questions after this session today. So that is just by way of introduction. So let us get straight into today's discussion. So the three panelists that have joined us is, first of all, Daryl Bennett. He's a senior wealth advisor at Sasfin Wealth with many years of experience and he also regularly features in the media. We then have Charlene Ricks, who heads up Sasfin Healthcare Consulting. And then last but not least, we've got Sarah Simpson, who is the head of our fiduciary function. Now, I think before we get into the specific areas of financial planning, I want to start off by maybe touching on why it is so important to focus on all three elements of financial planning. And Daryl, I basically want to start with you. You know, when you go to London and you want to step from the platform onto the train, they remind you to mind the gap. And I would like to make the statement to say that I think most people focus way too much on the wealth creation or investment component of their financial planning, and they do not sufficiently consider aspects such as insurance and their estate planning and their medical aid as part of constructing a well-constructed personal financial plan. So would you agree, Daryl, that this is the case? And then also, what would be the dangers of leaving that gap in your financial plan?
Okay, good afternoon, Johan, and good afternoon to all the viewers. No, you're quite right. One's got to be very careful, and one's got to look at one's plan holistically. So when you talk about leaving a gap, there's a couple of points that come to mind. The first one being the will. A person may have drafted a will many years ago and their circumstances may have changed and they may not have updated the will. So, or they might, the biggest myth is that everybody's got a will. You've either got a will with the state or you've got a private will where you've nominated your spouse as an executor or an attorney as an executor. So you don't want a situation where you've passed away and your spouse has to go down to the master's office downtown Johannesburg to get letters of executorship. That's a big gap in one's financial planning by not having a will and not having the will current and up to date. Another aspect where there could be a gap is if there's no liquidity in the estate, Johan. You know, one could have one's assets tied up in property. So it may not be the right time to sell the properties to have to pay for taxes like capital gains tax or estate duty. It could be prudent to hold on to cash or have a life insurance policy to provide for liquidity in the estate. So those are two aspects that come to mind of perhaps where there could be a gap.
Okay. Daryl, so being a seasoned wealth advisor and having seen many clients and new clients, where do you start when you see a potential client for whom you need to design a comprehensive financial plan? Basically, what is the first set of information you need to obtain in order to establish what the client's needs are and then to start developing a financial plan?
Okay, so I like to use the analogy of a jigsaw puzzle. And in fact, I've just completed an amazing jigsaw puzzle with my children. It was a 4,000-piece puzzle. Yes, I'll say that again, 4,000 pieces. I don't know if you've got to be mad, stupid, or brave to try and put that together. But in any case, the analogy with financial planning and a jigsaw puzzle is that it's important to put the pieces of the puzzle together as far as understanding the client's situation in their life, their background, their history, their experience with previous planners, the experience with life insurance, with assets, with all sorts of things, fiduciary aspects. So by putting the piece of the puzzle together is basically saying, is data capturing and starting off with what their assets are, what their liabilities are, what their income is, what their expenses are, what their goals, objectives. And one must be mindful that although one is planning and puts a plan in place, there's always moving parts. So the important thing is when one is reviewing the plan on an annual or quarterly or biannual basis, just to update it because there may be material changes that have happened over that period.
Okay, so let's move into maybe more of the area of your expertise when we talk about maybe the investment planning part of it. So you've got a good idea of the client's circumstances and their financial needs now. How do you then go about assisting a client in constructing an investment plan as part of their broader financial plan, where they are able to meet a variety of objectives over different time frames?
Okay, so what we do, and I think it's very important, is we do cash flow planning, and we've got cash flow models in our tools so that depending on the client's needs, we use different buckets, and we can have different asset classes in different buckets or a combination of the two. For example, in investment planning, if one's dealing with a retiree and they need income for the rest of their life, it would be prudent to put cash or income funds in one or two buckets so that when we have a situation like what's happened at the moment, and there's a lot of volatility in the markets, one doesn't necessarily have to dig into their equity holdings, because there's cash and cash flow that can provide them for an income for the immediate future. As far as long-term planning is concerned, as far as investment planning is concerned, it depends on the client's risk profile, and it depends on their needs. And one does strategic asset allocation, incorporating the different asset classes into the plan.
Okay, so I think what I'm also hearing is that one have to differentiate between a client's ability to take risk and the need to take risk, because sometimes you just can't get away from it. You basically have to take on some risk to get the kind of returns you need, but also with the appropriate time frame in mind, you can actually afford to take that kind of risk. And I think that leads me on to the next question, Daryl. You know, obviously we've with the COVID-19 pandemic and the impact it had on markets, specifically in March, we saw the JSE drop 12% in March. And guess what? Month to date, we're basically up again on the JSE 12%. But the risk during this period would have been that somebody would have abandoned their investment strategy and decided to sell out of the market. Now, why is it important to stay calm and not to make drastic changes to your investment portfolio or strategy during a market sell-off?
Well, Johan, it's important because, you know, if you push the sell button or you liquidate that portfolio, then you're actually realizing the loss. You know, you're actually realizing the loss. And if one can sit tight, and, you know, if we look historically, and analysts and research analysts have seen how markets and different asset classes perform, especially with equity holdings, the prices do come back and they do eventually get to new highs. So then you're not locking in those losses if you sell out your portfolio. If you sit tight, in fact, those are buying opportunities. If you're fortunate enough to have excess cash, is to buy more equities and to add onto the portfolio, but not to realize those losses by selling out.
And I think that's important because it's an emotional word, losses. And I think many times I find that clients basically make the statement that they've had a loss, but they actually haven't. As you say, you've only materialized the loss when you have sold some of those investments at the wrong time and basically at the bottom of the market. Until such time, you have actually got the same number of shares, the same number of units in your investment portfolio. All you're waiting for is for that to actually start picking up again. But I think, again, another question that has come up quite a bit. We know that we've got serious challenges in the local economy. There are, in many cases, limited opportunities for great returns. But the question is, you know, given the outlook for the South African economy, given all this volatility, the rand has been so weak, why should I not just invest all my money offshore? So what are the kind of things, Daryl, that one need to consider when you decide on should you invest offshore and how much should you invest offshore?
Okay, so I don't understand why, first of all, in 2020, especially talking about equities, why we differentiate between local and offshore. You know, I've led to believe that if clients have got an equity component in their portfolio, that they should be in the best companies in the world. And those best companies aren't necessarily on the JSE. And it's not an indictment or anything negative towards South Africa. I use the analogy, if you're sitting in New Zealand, you're not going to have all your money on the New Zealand stock market. Or if you're sitting in Belgium, you're not going to have it in that stock market. So it's prudent to be in the best companies in the world that to build portfolios over a long period of time. But you've got to be mindful, if you're talking about retirement funds, you're limited to the 30% rule where you can only take out 30% of your portfolio offshore. What I've done with a lot of my clients is, beyond the age of 55, is to commute retirement funds into living annuities, just to give them broader or more of an option to go offshore, so that they're not restricted to the 30% rule and have a combination of local or foreign equities. But I think it's prudent to have offshore, when I say offshore, but having the best companies in the world as the core of your portfolio. And once again, those companies are not on our market.
Okay, and I think the important thing there is that when one decides to invest offshore, it's not just about the currency call, the exchange rate call. It's very difficult to get the timing on that right. It's really about portfolio diversification. It's about looking for more investment opportunities, looking for areas where there's maybe more value in the market. But the fact is that many people, or most of us, still have local liabilities in rands, and one should always just think about that as part of a well-diversified portfolio. I think the other question, Daryl, that has come up, and it's quite relevant right now, given the fact that there's been some pressure on capital values of investors, and also the fact that interest rates are now at historic low levels. What do people do that's dependent on the income from the investments? They are really feeling the pain right now. And how would you say should someone that is taking a monthly income on the investments think about limiting the impact of drawing down on their capital at an increased rate right now?
Well, if they can afford to, well, then absolutely. I know the government has announced that they will allow people with living annuities to reduce the minimum drawdown from 2.5% to, I think it's 0.5%. Right. And on the flip side, for people who need income, to take it up from the 17.5% to the 20%. We're just waiting for a note from the reserve, from Treasury or the Reserve. I'm not sure where it will come from government, until the asset managers allow those changes to be made. But once again, if people need an income, then cash is the place to be at the moment, and should have that bucket filled up so that they can have drawdowns for the next 12 to 24 months.
All right. And I think, another question that's also been quite topical of late, and that we've been getting prior to this webinar, is the fact that we've seen the bottom of the market now in mid-March, and many of the clients have been asking the question, have we missed out on this opportunity to buy into the market on the at the lows? How should investors be thinking about this?
Well, I think, like in any circumstance, one can never really time the bottom, just like you can't really time the top. So it's a good time to sit and to, I guess, analyze your expenses and your objectives and your goals, and just to see that everything is in line with where you want to go. And if the portfolio needs to be rebalanced, it's fine. But I don't think it's wise to try and time. It's more about being in the market than timing the market. In other words, it's very, very difficult to time the bottom or the top. Even before the COVID came along, the JSE had been moving along sideways for many years. So I suppose instead of trying to time the market, it's more important to make sure your strategy is aligned with the right assets and the right mix thereof.
Okay, thanks. So I think I'm going to leave you for now. I'm going to move over to Charlene. Now, Sasfin Healthcare has more than 20 years experience in providing consulting advice to employers, and we also support around about 20,000 members in Sasfin Healthcare. We've also designed the business model so that we can provide advice to both employers, businesses, and also to individuals. And just really, if you look at Sasfin Healthcare as a service provider, it's basically got on its panel the leading medical schemes, and is therefore able to provide really unbiased advice. But Charlene, then with that background, when having a discussion with the client about their medical insurance needs, where do you start, and what are the most important aspects to consider in finding an appropriate solution for employers as well as for individuals and their families? I mean, I'm thinking about the right type of provider, the right type of plan, whatever will be meeting the needs of that specific individual or the family.
It's not an easy task in that every member really and their family has their own needs. But what we have done is there's a process that we would follow, which is differentiated predominantly between whether it's an existing client, a new client, or an employer group. So why there's a slight difference between existing clients and new clients is that we've got a model that allows us to go back 4 years and analyze the claiming trends that member and his family or her family would have experienced over up to 4 years. And that then gives us at least a basis on which to start those discussions with a member and then get an understanding of what they actually need going forward. With a new member, we obviously don't have that history at our fingertips. So we would then start rather with first understanding the history and then looking forward to what they would need into the future. And the main things that we obviously have to look at is hospitalization. So what kind of hospital events or expenses have they had and what do they expect? Whether they have any chronic conditions. And then at the moment, or over the last few years, oncology has been a very big driver on how we then position that client and which scheme and then option we would then place them on. Another aspect is obviously the day-to-day expenses. And that really falls with, members use day-to-day a lot more than the others, whereas the other benefits have a lot higher impact financially on members. Once we then identify which or what medical benefits they require, we're then able to tie them or link them into a scheme and then identify a few options that would best meet those needs. Then the balancing act comes into play, in that we then need to understand what they can afford to pay for the benefits that they require. And where I say that this needs to be a balancing act, it's really around often members need a very comprehensive plan, but can only afford a certain level. So members need to understand what it is that through that cost benefits they'll be losing, and whether that loss or reduction of benefits outweighs the cost that they'll be saving in terms of contributions. The model that I referred to earlier also allows us to be a bit more proactive with our existing clients, in that each year we look at the claims over the last 4 years, and we actually engage with that member and notify them of the possibility that they are overinsured, which means that they're paying for benefits that they haven't utilized over the last 3, 4, 5 years. And then on the other end of the spectrum, those members that we've picked up have utilized their or run out of benefits before the benefit year has ended. And we engage at both levels. Where we do, or how we do this analysis for an employer differs slightly, in that obviously from an employer's perspective, they want to be on a scheme that is financially stable. So there, when their members actually do claim, specifically those high ticket benefits, like I'm in hospital, can that medical scheme cover the cost that's going to result from that? And then from that, we need to find a scheme or a combination of schemes. So some, depending on the size of a company, you could have more than one scheme, where then those benefits cover the needs of the majority of the members, and then also has the flexibility of different entry points in terms of cost or contributions. Okay,
so I think if we look at the aspect of the affordability of medical insurance, a lot of people basically just decide that they're going to go for a very basic type of plan. And then something comes into play that they call gap cover. Can you maybe just tell us a little bit more about what is gap cover about, and how should one actually make use of gap cover to be there as an additional level of insurance for somebody's medical aid needs?
Gap in the past used to be a very nice to have product, but the more and more the way plans are changing, gap has now become a necessity. And why I say that is, we're seeing a definite trend of members moving options, or downgrading options, because of affordability. And when they downgrade those options, either there's a reduction in hospital reimbursement rate. And what that means is, when you are hospitalized, often you'll read in your brochure that the scheme covers at 100% of scheme rate. And many members assume that that means that 100% of the cost will be paid, when in fact, that's not the case. So what would happen is, you would have your medical scheme that's negotiated at a certain rate. So for a specific procedure, they might pay 5,000 Rand. But because providers, like your specialists and surgeons, their rates aren't regulated, they can charge you whatever they deem fit. And they could charge you 10,000. Now that difference of 5,000 Rand would be for your own pocket. And that's where gap would then cover that difference. In addition, to make options a bit more attractive from a costing perspective, medical schemes have introduced deductibles. So for certain procedures, you have to pay a first Rand co-payment before you're hospitalized. And those deductibles have grown in size, so the quantity of the co-payment, as well as the number of procedures that these co-payments are applied to, has also extended. And again, whilst most people enjoy surprises, nobody enjoys it when it comes in the form of an invoice that you're not expecting or haven't planned for. So in order to allow members to select the right option based on their needs, but also protect them against any uncertain risk or something that you can't plan for example, even in the case of oncology, because of the developments in biological medication, a lot of schemes have put either a benefit limit in place, or once you reach that limit, there's a co-payment that you'll be liable for. So for example, once you reach a 200,000 Rand limit, you would then need to pay 20% of all costs linked to oncology for the remainder of that benefit or 12-month cycle. So if you're thinking about a 100,000 Rand bill, you would need to find 20,000 Rand out of your pocket to fund for. So many of these gap products would then cover you for those kind of unexpected events. So like I say, really moving into the future, gap products are not a nice to have any longer, but a necessity in the holistic healthcare planning perspective.
So if we move on to the current environment we're finding ourselves in, what kind of needs have you seen that's been expressed by medical aid members, and how have you been able to support the members during this COVID-19 pandemic and the lockdown period? Just what is the general trends that you're seeing, and how can you assist people?
Okay, so again, unfortunately, where we have seen that certain clients or employer groups have not been able to either pay full salaries, so members are getting less in their pockets, they are looking at ways in which to reduce their medical aid contributions. So in that terms, what we can assist members in is understanding what their options are, so whether they can downgrade during the year and where can they go to. So you can reduce your costs by staying in the same range of option, but maybe opting for a plan within that range that is linked to a hospital network and reduce your contributions. But again, members need to just understand what benefits would they be losing and whether those benefits are not, they shouldn't be greater than the contributions that they're saving per month. In addition, I think the medical schemes have been very good with communication. But I think, and I'm sure everybody has got it, where we've been inundated with information around COVID. So what we've been trying to do is extract certain very important, so what are the benefits available to members? One of them obviously is that COVID has been confirmed by the Council of Medical Schemes to be a PMB, which is a prescribed minimum benefit. So all schemes have to pay for this, which is the diagnosis and treatment in full from the risk benefit. So just to make members aware and put their concerns at bay, that they won't be exposed if they were to contract or be diagnosed with COVID. And then from that contribution or the communication perspective, also just to, like I say, highlight to members where there are certain benefits that have been improved on. For example, discovery, specifically for if you're living alone and you do get ill, that you can then use one of their partner hotels, the Capital Hotel, where you can go in, your accommodation is far reduced, and then there members can get fed 3 times a day, there's a nurse on duty, etc. So just to make members aware that they have access to these types of benefits.
Charlene, then that's from your perspective, what benefit enhancements have there been made by the medical schemes? Have you found that there was specific mention about any exclusions that our clients or members need to be aware of?
So with regards to obviously downgrading, as part of assisting members in their cost perspective, is that there are certain exceptions or concessions that medical schemes have made, in that either giving sort of like a freeze in contributions, but then making the member aware that during that time when they're not paying contributions, they won't obviously have access to benefits. If they then decide to actually leave the scheme in totality, what would happen is obviously they would be exposed in terms of underwriting. So when they then decide to rejoin the scheme, they'll be subject to either a 3-month, a 12-month pre-existing condition, or what they call an LJP, which is a late joiner penalty. So their contributions will be loaded by a certain percentage, anything from about 5 to 75%, depending on how many years they haven't been on a regulated medical scheme. So members just need to be aware of those type of exclusions if they take the decision to leave a scheme. With regards to the actual treatment, if they are a member, there will be no exclusions unless they are currently within their 3-month general waiting period, where schemes then don't have to pay for any benefits, including what they call as PMBs, which COVID has been confirmed as.
So if we look at, obviously blood tests are extremely important when it comes to medical aid insurance and also your life insurance. What has been the arrangements and how are the medical aids dealing with this kind of need for doing blood tests where they actually can't in this kind of situation?
So with regards to the medical scheme, so underwriting is more based on, so in certain cases when you apply for a to join the medical aid and you haven't been on and you're joining as an individual, they could ask you to go for certain checkups and etc. So things like a full medical or results from your doctor. But in many cases, if you are suffering from a current condition, your doctors would have those reports, and then through your virtual consultations, you should be able to extract, specifically if it's historical information, so something that your doctor would have on file, and they could use that to substantiate or allow them to underwrite you appropriately.
Daryl, just to maybe jump back to you on this point of financial assistance by insurers, what have you been seeing on the short-term and life insurance side? Have any of these service providers come to the party? Are they accommodating some of the clients from a premium perspective, for example?
Well, I know on the short-term side, Discovery were offering discounts on premiums for motor car insurance, which was fair. It was depending, they've got all the data, so they can analyze each member on their own merits. And I received a text message to say that there'd be between a 15 and 25% reduction on my premium for the month of May. I've yet to see the debit order go off, so I'll be able to confirm once that's happened what discounts they applied. From the life insurance side, I don't think any of the life companies are allowing nurses to go out and do blood tests or medicals at the moment, but some of the companies are writing up policies and then giving the members, say, a month or two after COVID in order to do the tests that are required as far as underwriting is concerned.
So just before we move on to Sarah's area, Charlene, just one more question. Can you just give us some idea about the kind of experience of a medical aid like Discovery, which is really one of the bigger ones, in terms of people being tested, the infection rates that they've seen, and also the hospitalizations?
Okay, so the last update we received from Discovery was around about the 16th of April. But over that time, they had conducted on Discovery Health members, and Discovery being one of the largest open medical scheme would give you probably a really good gauge, is that there were about 19,000 members that were tested. Of that, there were 630 or so members that came back as positive for COVID, and 123 of the members have actually been hospitalized. So at the moment, not a huge, so actually the ratio is slightly higher than the norm, but that is also maybe talks to the fact that members in the private healthcare sector are able to access tests and et cetera a bit easier than when you don't have healthcare.
Okay, so we're moving then on to the wealth preservation side of our discussion. Sarah, there's a few things that we are certain of in life, and unfortunately one of them is death. We are living through a period right now where the possibility of death has very much risen to the surface. And it's therefore very important to address this very unpleasant reality of death and what we need to do to ensure our financial affairs and make sure that they are actually in order should we pass away. So from the fiduciary function, you know, I see it really much, very much as a gatekeeper. You know, while we can plan and invest and have medical insurance as much as we like, all of this can come to nothing overnight if someone should pass away and they do not have their will and estate planning in place. Daryl also said, you know, his first discussion that you will have with an individual would typically be around things relating to the will as a starting point. Can you maybe just tell us a bit about what it is that you would focus on in your first discussion when starting to look at someone's estate planning?
Johan, I think it's very important to distinguish between a will and an estate plan. I speak to many clients every day that say that they have an estate plan quite simply because they have a will. The will is a document that captures your wishes and makes sure that everything is legally and technically feasible. So I just want to go back into the basics with an estate plan. You can't really say that you've got an estate plan unless you've gone to the lengths of considering whether your will's dealt with your offshore assets, which jurisdiction those offshore assets are in. If you've dealt with those assets in your South African will, we need to make sure that our laws are even applicable to assets in those jurisdictions and that they don't contradict the laws of those jurisdictions. And it's also important to assess whether there would be inheritance tax or even double tax agreements between the jurisdictions that would allow you some reprieve from a double inheritance tax insofar as you apply your estate plan to your offshore assets. This can be an exceptionally complex area, and one cannot just refer to offshore assets in one South African will. Another thing that would form part of that estate plan is looking at different businesses. Are you a sole proprietor? Are you a shareholder in a PTY? Looking at your wishes. Have you ever sat down to decide whether you have a family member that's going to inherit those shares? Are you sitting with your business partners to see if your business partners are going to buy you out? One of the biggest technical difficulties that we deal with in administration of estates because of poorly drafted wills is not getting the valuation of your business correct. So many people think that the valuation is the value as agreed upon between the shareholders, which is very often the case. But unfortunately, when it comes to valuing a business, SARS does not look at it that way. SARS has a certain way of valuing businesses because they obviously want as much tax as possible. And it makes it very difficult for an estate when you have a willing buyer, willing seller scenario and you attribute that value to a business and your will is drafted around that value. So understanding SARS's valuation of your business on death would become very important, and also what's going to happen to your shares when you pass away. Another thing that I see that people often overlook in wills, and they should have in an estate plan, is if you have a trust or a family trust, is have you dealt with replacement trustees? Have you looked to see if there's a termination clause in the trust that suddenly your trust ends 50 years after your death and your beneficiaries don't realize? And also understanding how your loans to the trust would be dealt with on death. Those are all items that you have as a desire that you should actually be putting in a will, even if it's a wish, to lay out the map and a foundation for your executor to understand what your wishes are. Also looking at joint finance structures. Very often people have unusual financing structures, possibly joint properties that they have shareholdings in with a lot of partners that they've signed sureties for, and very often they don't add what they want to happen with these structures into their will. So the executor is left to make all these decisions, which really should be your decision and something you want to implement and that you lay out very carefully. And I think, you know, this is a very good time, and this is a tough time for us, but this is a time where you're actually forced to look at all those pesky little emails, the envelopes that you haven't opened that are lying on the counter, and take this time to collect all the letters from your creditors, your policy documents, your car registration details, everything, and put that in one single file so that firstly, when you do have access to a specialist, you can compile a proper estate plan, but also a family member can find those documents easily and not have to scratch through CompuShare certificates, that there is a single accessible point of information that helps deal with the will if you do pass away.
So you've covered a bit of the business owner's side and the valuations. Is there anything specifically, because we've got the individuals, and then we've got people that's also business owners. Is there anything specific around the business ownership that you still want to add?
Very much so. So I think, Johan, what I would say to each and every business owner, and this is a tough conversation to have with oneself, but what would happen to my business if I do not arrive tomorrow morning with my cup of coffee at my desk? If I was not there, what would happen to my business? And then you need to lay out the foundation of what you want to happen so that a fiduciary specialist or an advisor can help you implement that. So these are instances where we would look at business risks, and we would do an analysis of business risks, and you would have a look at business continuity, from absolutely anything to what's going to happen to my shares because I'm an owner in the company, what's going to happen to the managers' management structures because I'm a director in the company. All of those need to be laid out in a very careful plan. Another thing that I find with shareholders and a lot of business owners is that they set up the legal documents in certain phases, and a lot of them get to a point where those documents are not compatible and they don't correlate. So typically you would have registered your company, and then down the line you would have created a shareholders agreement which would have been signed between the shareholders, and a few years later they would enter into a buy and sell agreement. Now very often those documents don't speak to each other, and in fact I find that many times they actually contradict each other. So it's very important to take this time to take all those documents, to have a look at them, your memorandum of incorporation, your shareholders agreement, where applicable, your buy and sell agreement, the actual contract, the actual policy that backs up the buy and sell, and make sure that those documents all speak to each other. A typical example is a lot of buy and sells might just have a death cover in the policy side of things, but the contract might speak to death and disability, but it's not accompanied by correct supporting documents. And the valuation of the company is out of date because you all agreed that every year you'll sit down and you will revise the valuation, and it hasn't been done. So those are very important things to focus on as a business owner.
So then just another type of client we typically would see is the one that has got a trust. What are some of the most important things that these individuals have to think about when it comes to setting up a well-structured trust?
So I just want to relate this back to the last question, was the business owner. One area that can create huge technical difficulty for a client is if they are co-shareholders in shares and one of those shareholders transfers their shares to a trust. When one shareholder does that, it completely disrupts the nature of the buy and sell. It also creates certain estate duty effects for the other shareholders that are unanticipated. So if you happen to be a business owner and any one of your co-business owners has transferred their shares to a trust, important to reassess and reevaluate and have a look at the estate duty effects. And then Johan, your question surrounding trusts, this is a very interesting time to revisit trusts. A lot of people have been put off by trusts because of the deemed donation on loan accounts. Given the drop in the interest rates, it would be very interesting to see. So what I was saying is that a lot of people were really put off by trusts because of the deemed interest that was levied on those loan accounts. And over the last 2 years, a lot of people have been dissuaded from using their trusts because of the very high rate of interest and because of that deemed donation on that interest. Because of the lowering of the interest rates, it may be worthwhile considering utilizing those trusts and utilizing those loan accounts. And now might be a good time given the fact that the interest rates are quite low. And I was saying that anybody who has trusts and loan accounts to trust, this would be a very good time to sit down with your accountant and your financial planner and reassess if for once the interest rates are actually working to our advantage, and maybe there's a lower deemed donation on those interest rates on the loan accounts to trusts. So for once, something may be operating in our favor.
So, Sarah, one question that's come up a few times during this lockdown period, which we don't know for how long it will still last, is that of the signing of wills. So somebody now has taken the time to review their will and to update it. And how can people now go about getting their will signed if they're looking to update it during this lockdown period?
This is a very difficult technical question. So obviously we all know that the Electronic Communications Act does not apply to the signing of wills. It's something that has been considered quite a bit in South Africa, but it's not been accepted as yet, quite simply because there's too much margin for fraud. So that leaves us in a very difficult situation where we have all the time on our hands and we want to draft our wills, but it's very difficult to get them signed. There are a couple of ways in which one can do it, and I'm just going to go through the basics. Whilst I'm not advising anyone to break the law here and break their lockdown, some of us may go to pharmacies to get a prescription, or you may be seeing doctors for medical help. That might be a very useful chance to ensure that you have a witness there under the correct situations and without breaking lockdown. Where you have neighbors and a gate and a wall between you, it's not impossible to stand there with your will, keeping the correct distance, signing it, passing it through, and letting that person sign as a witness for you. So there are quite a few situations which I'd like to break down on a case-by-case basis. And I would prefer that if anyone had a question that they would rather redirect it at me and we can assess that question directly. Just so that you know that you are not completely without reprieve. If you feel that you have to sign your will and you are all alone, there's nothing preventing you from signing the will, signing a declaration to say I'm under lockdown, the circumstances did not allow for proper witnesses. I had to get someone who's usually not allowed to sign as a witness because of their age or because of their capacity or their relationship to me to sign as a witness, or I failed to get the requisite number of witnesses. And put this down in a declaration. And if that is the case, we are allowed in terms of the Wills Act to take that will to the High Court and get them to consider the circumstances in which the will was signed and allow them to pass that as being a legally valid and binding will. Now, whilst this is not recommended in all instances because it's a highly costly process, if you're without a will, this is a very good thing to do anyway. What I would suggest, though, is this is something that you can use as an interim provision solution, not a long-term solution. So I would advise, if you are pushed to do this because you have no will whatsoever, or you've had to sit at your desk and handwrite your will and put a declaration to say you have no witnesses, once lockdown is over, please do have that will redrafted and have the proper witnesses sign it in the correct manner. So you're not without any resolve. But please, if there are questions, I'm really offering to answer those questions personally, and we rather deal with those questions on a case-by-case basis, so we can make sure that each and every person has done everything that they can to get their will signed.
Sarah, I think you just confirmed to me again, you know, that while you can have a Daryl that can pull everything together, you still need the specialist in each of these areas of financial planning. Just the last question to you. Because I do want to get to one or two questions from the people on the webinar. How will life be complicated for our clients should they not have a will in place on the day that they pass away?
So, Johan, given the brief time that's left over, I'm going to deal with your question very briefly. You will die intestate. That means that your will is divided up in terms of South African law. Typically, someone with a husband and children, or a spouse and children, their estate would be divided up equally between their husband and children. If your children are minors and that estate is cash or includes cash, that money can go and be locked away in the guardian's fund until that child reaches the age of 18. This makes a huge amount of difficulty for people trying to access the funds if it's locked in the guardian's fund. And it's not to say they cannot get it, but it does make it difficult. And also, you haven't had the option to choose your executor, which is a very important choice. Another thing is that there are no guardians nominated for your children, and that decision would then be left to the master of the High Court, which is not great. So that would be the effect of not signing a will, the major effects.
Okay, thanks. Then just maybe to look at one of the questions that we've received for you specifically, Charlene. The question says that you mentioned that COVID has now been confirmed as a PMB, and there's a certain number of PMBs. The person says 15, I think, available to a member per year. So let's say the person has used up 10 PMBs already and are then diagnosed with COVID. meaning that there basically is only 5 available, and say COVID will require more than 5 PMBs, will a member have to pay for the rest of the sessions out of their pockets?
Okay, so maybe there's been a bit of a confusion because so how PMBs work is that what they would do is you've actually got 271 emergency PMBs, so certain conditions that if you were rushed to hospital, that they would have, your medical scheme would have to cover. And then you've got 27 PMB chronic conditions. So where they might be referring to, you've got 15, they might be referring to more around consultations, but those consultations would only be for non-PMB conditions. So where a plan has got certain set of buckets of benefits, they might say, on that plan, you've got 15 visits to a GP. After that, you pay for those. PMBs would have to still then be covered in addition in terms of the Medical Schemes Act. But I'm more than happy if that person's details can be sent through to me. I'll look at what option and plan they're currently on or scheme, and then provide a sort of like an individualized response to that person.
Charlene, just, while we're with you, the one question, going forward, how will members benefit from the way in which medical aids and healthcare providers provide services to members and patients post-COVID-19?
Okay, one of the big benefits that I've seen, and it's not something that's new, it's just really taken off because I think we've now been forced into this quarantine or isolation state, is that virtual consultations. So and it's been launched quite nicely with partnership between Discovery and Vodacom, where on lockdown, onto all South Africans, not just Discovery Health members could use these virtual consultations. To about the 16th of April, they saw about 2,500 members take up this option or offer. So it's now being embraced both by the actual specialist or providers, so your GPs, because I think they were a little bit sort of anti this virtual consultation setup, as well as by members, because they're forced to use this way or avenue to consult with their doctors. And I do think it's going to have a positive impact, because if you think even outside of COVID, if you're going into a doctor's rooms, you might have the flu, or you might just be going there to get a repeat script for your chronic. You're then exposed to everybody else in that doctor's rooms and what they are suffering from. So that's one thing. Another one is also from a cost perspective. A lot of the virtual consultations are at a little bit of a reduced fee. So in terms of contribution increases year on year, that might have a positive impact. And then just people in areas where they can't access, for example, GPs. And this virtual consultation has now been extended. My son, for example, is obtaining speech therapy through Zoom. And so I think it's got a far-reaching impact positively in various avenues. Like I say, cost as well as just accessibility in those areas that normally wouldn't be able to access those kind of consultations.
Okay. Daryl, I've got a question here. It's quite a brief question. I'm not sure we've got all the details, but the person is basically saying that they're retiring at the end of 2022. And they do have the option of leaving their funds in the Provident Fund. And that's assuming that they can actually still live off the spouse's income, as well as drawing down on some of their equity-based type of investments. And they would want to know what we would advise.
And you need a little bit more information around what the client's needs are, and perhaps certainty, or if they definitely are going to retire in 2022, I'd need to see what their underlying assets in the fund are, and if they have got other assets that's outside the fund. So one would need a little bit more information to give better advice.
Yeah, I think, and that's the point, Daryl. I mean, the fact is that it's only really when you can have all the information at your disposal that you can really start making, like give informed kind of guidance to somebody, and it really is not sometimes as simple as the clients really would think. I think there was one comment in here, it was just basically saying, because we've been saying that clients should sit tight, they should not be making drastic changes to their portfolios, and the person was saying, but if we never sat tight in February when investments managers could or should have been aware of the risks, which were fairly apparent, clients wouldn't have gone through this kind of period. But I think the point there is that, unfortunately, hindsight is a perfect science. And it's only after the fact that we can now clearly see the signs that were there. And I think, everybody would agree that, for example, COVID-19, the coronavirus was a black swan event, meaning that it was unexpected, meaning that, it was difficult to quantify. And to this day, we are finding it difficult to quantify what this will have on the market. So, it's again a case of one should really be careful of trying to time the market, and one is always, I think, a little bit wiser after the fact. Then, Daryl, maybe just one last question before we close off, because we've got about 2 minutes to go. Just back to the point about short-term and life insurance. I think one of the questions is, people sometimes have insurance, they don't know if it's the right type of insurance, they don't know if it's got sufficient insurance. How do you go about, thinking about the assets they have, the liabilities there, how do you go about determining what type of insurance somebody should have, and also how much, to try and close the gaps?
Okay, so from a long-term insurance perspective, there are three main silos of insurance. One of them would be life insurance, the other one would be dread disease cover, and the third one would be disability. So life cover is the need for life cover, and it all works around people's needs. It could be for liquidity purposes in the event of the breadwinner passing away. It could be for liquidity purposes for taxes, estate duty, executive fees, capital gains tax. It could be liquidity to buy a partner's share out of a business, like Sarah was talking about earlier, buy and sell insurance. It could be liquidity for a key person. So there's different needs that is associated with life cover. The dread disease is a bit more of a moot point. I believe that if one has got a lot of debt, one should have dread disease cover. If you've got a mortgage bond and you get struck with the dread disease, it might be prudent to get a lump sum payout so that you can offset the debt. But it is a moot point. And disability, I think, is very important, or income protection is very important if you're working to protect the loss of income in the event of a disability. So once again, it's personal. There are all sorts of different policies. Some policies have got cash components with it, others don't. Some are older generation, others are new. There's T's and C's. I'm sure the T's and C's will be updated all the time with the COVID-19 that's just that's arrived. So one needs to look at each one on its own merit.
Okay. Well, believe it or not, the hour has gone by very quickly. I think, again, financial planning, looking at the three elements, it is a very, very broad and deep topic, and we can actually have another few seminars, and we will most probably be looking at doing something around that. But we really want to thank you for making the time to attend our webinar on financial planning today, and for all your questions that we have received. As I said, we will try and get back to those that I didn't touch on now. We really hope that you have gained some valuable insight and guidance that will enable you to achieve your personal financial and non-financial goals and objectives. And we also hope that it will allow you to take better control of your personal money matters, and that this will provide you with a greater sense of comfort as well. So please remember again to visit our content hub at sasfin.com for more information. Should you have any further questions, or should you want to speak to one of our advisors, you can just make use of the email that was sent to you as an invitation for this webinar. Just respond to that and we'll get back to you. So from myself and the Sasfin Wealth team, be safe and look after your health, as that is the biggest asset we will ever own. Also, just make sure to be very vigilant when it comes to messages or emails that you receive where you cannot clearly identify the sender of that message, as fraudsters and opportunists are quite active at this time, and they do want to get access to your savings and investments. So from us, have a good short week, and we hope to see you at our next webinar. Thank you very much.